Correct. We do not have class next week. The exam will be online.
Okay.
And in fact, I've got some good news. I'm going to put the exam online today.
I love you more.
And you can take it anytime between now and Thursday at midnight.
Okay, the last day is going to be Thursday?
Yes.
Okay.
But a week, next Thursday at midnight, just get it
Yes.
done before then. All right, so let's go through class one step at a time. Question?
How many questions on the test?
22.
That's fine.
22. 3-hour time limit. I imagine everyone will get done before then.
Mm-hmm.
So there's a couple little tricky questions. But
I know, you always do that.
on the whole, I would say it's a fairly easy exam.
Okay.
All right, so class one. What do we got here? Time value of money, future value. Everyone knows this formula? Future value, present value with some junk. All right, if I ask you a future value question, just flip to that page, crunch it on your calculator. Present value is just a future value formula rearranged, right? And if you, Patrick, if you need me to slow down, let me know. Okay. Perpetuity, value of the perpetuity, payment divided by the interest rate. If you asked a perpetuity question, flip to that page. Now, what's the difference between a perpetuity and a growing perpetuity? Anyone remember? Or a growing perpetuity is if you get payments forever, but they're growing by some amount. They grow 2% per year. And if we ask you on the exam, what is the value of this perpetuity? You're going to get $100 next year, and it's going to grow at 2% every year. You're going to use this formula. Payment divided by the interest rate minus the growth. And it's going to be a little bit bigger because the denominator is bigger. All right. Chapter 2, free cash flow. All right, free cash flow is ultimately the value of the firm, how much free cash flow it can generate. And we have a way of calculating that free cash flow that we like, which is NOPAT. We like that NOPAT figure, net operating profit after taxes, because it assumes no debt. It is devoid of interest payments. And in addition to calculating NOPAT, which we do by taking earnings before interest and taxes and taking out the taxes, we need to subtract operating capital. Now, operating capital can incur for a couple of reasons. We can increase operating capital if, say, we buy a building. It doesn't show up on NOPAT, but it decreases our cash flow. Operating capital, hey, how you doing? Hey, how you doing? All right, the cavalry has arrived. I've got a little take the pressure off the three of you. So operating capital can also decrease if we do the stuff we talked about last week, which is, say, increase inventory, or say we increase accounts receivable, or say we pay off our accounts payable too fast. Did you watch the video from last week, Seymour?
Mm-hmm. Yeah.
All right. So those are the reasons why operating capital can decrease. That's all stuff that will not show up on NOPAT, but will decrease the amount of free cash flow that you have. And I think there is one calculate the free cash flow question on the exam. Okay, and then working capital. We talked about this working capital. So in addition to the fact that you buy a building, and that's going to decrease free cash flow, you could also increase working capital, the ways we talked about last week. Higher inventories, higher accounts receivable, lower accounts payable. And you might want to just earmark this page if you need it to calculate working capital. It does include cash, inventory, receivables, does not include short-term investments because they're not part of operations. Okay, we did an example of that. Calculating NOPAT, calculating free cash flow. Okay, and then we talked about capital budgeting. We talked about net present value, which is pretty much the same as value, except it's with the initial investment subtracted off. So if you're given a problem, say it has these cash flows over the next 5 years, it's going to cost $100 to start, and the appropriate risk interest rate is 8.5%. you can use that information to calculate the net present value of that project. And in Excel, I believe, correct me, Patrick, if I'm wrong, but I think in Excel, to calculate the net present value, you hit equals, open parentheses, discount rate, comma, cash flows starting in year 1, comma, initial investment, close parentheses. Does that sound right?
How long do we have for this? Because in case we have to Google that or YouTube it,
You'll have 3 hours, and I mentioned earlier that it's only 21 or 22 questions.
Okay.
It's
Not
a
only-
little tricky if you're not familiar with it. It's just-
Yeah.
Wait, what was that?
Me and Pat tried it. It's a little tricky.
Wait, did you try it, Patrick, after I sent you that email?
I tried it, and I was trying to remember what we were doing that night. And I was looking at your email, and I just...
I tried
Yeah.
looking at it with him, and we couldn't get the number.
Okay, well, we can do it. Should we do it now?
Yeah, let's go.
Do it now? Is that yes, no?
Yeah.
Sure.
All right, yes, do it now. All right. Let's see. You're all programmed. Microsoft Office.
I have your number.
Oh, you got that?
Yeah, she gave it to me last night. It was too good.
Actually, let me
Net present value Excel.
materials. Okay. Okay. All right. So let's see. So here is some stuff. All right. I've got this this cash flows. All right. The initial investment is 844. Can everyone see that? Okay, initial investment 844. In year 1, we're going to get 298. Year 3, we're going to get to year 2, we're going to get 334. This is year 3. This is year 4, and I've calculated the NPV is 25. So let's see if I can calculate it in this. So I'm going to hit equals, open parentheses, NPV. Wait, equals NPV. Open parentheses. So first I need the rate, which is 6%, comma, and then I need the cash flows year 1 through 4, comma, and then I need the initial investment, close parentheses, fingers crossed, 25.23. Ah, man. All right.
He's
Do
Okay.
you want to watch the 8-minute YouTube video that I'm watching right now?
No,
Oh.
even it's too.
Wow, why did that happen? Alright, NPV, rate, value. Alright, let me pull up the email I sent Patrick. See if that will help.
No, Pat, we didn't combine them. Let's combine
Email
eight,
message.
and we just put each one in the parentheses and number. Maybe that was.
I know.
You'd be in Excel.
That's
Okay, rate, cash flows year 1 and beyond, minus, maybe we need to go close parentheses minus the initial investment.
See if that does it.
Alright, so let's try that. Okay, equals NPV. Okay, and then we're gonna go, plus because it's a negative initial investment. Alright, why don't we try minus? Minus, that's not gonna work because it's gonna be, okay. Equals NPV, the rate. What if we $sign this?
I was just curious.
We worked that out last night. With including the initial investment after the first comma, we need to close parentheses and add the initial investment. Alright, here's the YouTube video. Alright. I'm sorry, equals NPV. Open parentheses.
You don't have to make the values constant like you do with a VLOOKUP. Do you know what I mean? You know when you do a VLOOKUP and you're doing a whole big spread, and if you're like bringing down the numbers,
Mm-hmm.
and you put the $sign in there, so it stays constant, so it's not look. I'm just wondering if it's the same thing.
Yeah, I see what you mean.
Because if you're kind of opening up and you're starting with year 1 and you're kind of bringing it all over, is it just bringing over the 2.7? Even though it's in the formula,
Yeah.
it's bringing it over. Like when I run mine for work, like I have 230 stores, and if I pull up that first one, I have to make a constant, or that number at the top one is going to come all the way down.
Yeah.
So I'm just wondering, it's that you're not going down, you're going across. Do you have to make that constant? Did you look at the YouTube video?
No, I didn't look at the YouTube
Because
video.
there's one on here, like at 122,000 views.
Did they do the
It says
dollar
how to
sign?
calculate a net present value NPV in Excel.
Did they use the dollar sign?
I'm gonna look right now. Hold on.
What if we do rate and dollar sign?
Yeah, try the dollar
Rate
sign.
dollar sign.
See if that does anything.
Plus. I don't know. Alright, so we'll try it again.
I think
At
he's
the end of
saying
class?
just do one cell basically instead of the whole row. Maybe
Yeah.
that'll work.
That's what me
Like-
and Pat did.
Like don't do 2, 3, 4, just do one.
Equals PP. And first we do the rate, right? Then we do the comma. And then we do like this.
No, she's saying
just
just
do
one
the
or
first
comma, like first year,
Got
and
it.
then comma second year.
Got it. Comma. Alright. And then close parentheses.
Okay.
And then plus.
Wait, here it is. Okay.
Oh, I know what I'm doing now. Oh my God.
It's
I got it,
NPV,
I got it,
discount rate,
I got it.
range of
This-
values plus investment.
These are the cash flows. We need to use these cash flows. This is present value already. Okay. This row 5 is the cash flows. Okay. Oh, equals NPV, open parentheses, rate, comma, and then we use row 5. These, okay, yes. Then we close parentheses, and then we go plus, and this will definitely work.
Okay.
Ah,
And so-
bingo!
Alright.
Go back to the formula again.
But how did you select it like that? Did you press shift and then?
Yeah, he's
Oh, okay, that's what was confusing me.
Wait, shift where?
He was
Or you
asking
can
how
just
you
drag
selected,
it
drag all the cells. You could
Oh,
drag
yeah.
it, you could
Equals.
shift
Oh,
and
what's it?
the arrow.
Picture
Oh,
of it.
sorry. No, I got you, sorry. Alright, so equals NPV, open parentheses. First you select the rate, comma, and then you select all the cash flows, not the row below, which is already in present value. And then you close parentheses, and then you plus the initial investment.
That's the one who's going to be on the test?
There is one like this on the test, and I would recommend you have it all queued up so you can just plug in the numbers.
Which is basically equals NPV, open parentheses B9, which was the 6%,
Comma.
comma C5 through F5, which is your cash flow for year
For all the years.
year 1 through year 4. Close the parentheses, and then you're adding
Initial investment.
the initial investment.
Yes. Okay. Excuse me. Alright. So we've got net present value. We know how to calculate that. Independent. What's the difference between independent projects and mutually exclusive projects? Mutually exclusive projects, the cash flows affect each other. So if you have 2 independent projects, you just look at them independently. And if they're both positive NPV, you take both projects. If they're mutually exclusive, meaning one affects the cash flows of the other, you take the one with the higher NPV. Okay, that's good. Class 1, right? Alright. Excellent.
And you added our, I saw that you added our participation grade in there?
Yes. Yes. And you missed the good news, Bill. The exam will be open tonight.
Are you serious?
Yes. And you can take it anytime between now and midnight on Thursday.
That is awesome.
Yes.
Alright. Good, I like when students say that.
My biggest fear was like Thursday morning, getting up at like 12 o'clock at night, and then like starting at falling asleep, and then because
Alright.
Thursday afternoon I'm not going to be in the right frame of mind. So
Alright, so beta. What is beta? Beta is the measure of risk for a stock relative to the market. This formula you may need to conjure up, bookmark that. If you are asked what is the cost of equity capital and you are given the beta, you will use this formula to take the risk-free rate plus the market premium times beta. And it can be a little confusing because sometimes you'll be given the market premium and sometimes you'll be given the risk of the market as a whole, which already includes the risk-free rate. There's a couple tricky questions on the quizzes, but you need to be able to differentiate between those two. Remember the intuition of beta, measuring the risk and the required return. And we looked at this graph, and we said, well, look at these two managers, CC versus JJ. We can see CC has a higher return, and CC's like, yeah, I did a better job. But we, being smart finance students, said, wait a minute. CC took much more risk. CC had a higher beta. Therefore, we demand a higher return from CC. And look at what a great job JJ did by decreasing risk and still picking stocks that outperformed. Cost of capital. We may need to calculate WACC. I believe there is at least one. Calculate the WACC, weighted average cost of capital, of this for this company. We will need to just put everything together. We will need to calculate the cost of long-term debt, cost of preferred stock, cost of common equity, and then we will weight them, given the formula that we've got in these slides for Class 2. In terms of calculating each one, let's take a look at loans. All right, now we will be given either the before-tax cost of debt or the after-tax cost of debt. The before-cost tax of debt is higher. Say the bankers charge us 10% on debt. That's fine, but we get a discount because interest payments are tax deductible. So we take the before-cost tax of debt, cost of debt, times 1 minus the tax rate, and we get a smaller figure for the after-tax cost of debt. That's how we calculate cost of debt when we're using WACC. Preferred stock, remember we talked about this being a layer of ownership between debt and equity, which had some interesting characteristics. One of which is that it generally pays a fixed dividend consistently. So we can use that fixed dividend to calculate the cost of equity. If Bill has a preferred stock share that he paid $100 for, and I pay him $6 each and every year, the cost of that capital, the cost of using his $100, is 6% each and every year. And that's the way we will calculate preferred equity. This $6 I mentioned I might be paying Bill, the price he paid, $100. And there's one other little kink to it, which is maybe when Bill purchased that stock for $100, he had to pay a broker a certain amount, and maybe I only got 95 of those dollars. So that changes the return. So it goes from a 6% return up to a 7 or 8% return.
because of that fee from the broker.
Yeah, so I'm getting less. I only got 95, but I still need to pay you $6 every year. So the cost of that capital is 7 or 8%. Okay. All right, and then calculating the cost of equity. There are two ways. One, we mentioned the capital asset pricing model, which was this formula we talked about a minute ago, the risk-free rate plus the market premium times the beta of the stock. There's another way we could sometimes calculate the cost of equity capital if we pay a consistent dividend to equity holders, we could calculate it that way. And the difference between equity holders or common stock holders is that they expect a growth return. They expect that stock to grow. And that's different from preferred stockholders who just expect a fixed dividend each and every year. So we use the same formula we talked about it a minute ago, except we add a growth component. The investors expect maybe a 2% growth each year. Not only that, but if we're given the dividend in our current year, the common equity holders will expect a higher dividend the next year. So we're standing here in year one. All right, the common equity holder, Greg, gives us $100 for this stock. He's expecting a dividend, or currently there's a dividend of $5, but he's expecting a growth rate of 4%. So he's expecting $5 and change next year. So that's how much we'll have to pay him. We'll have to pay him $5.40 or $5.35 next year. So that amount that we need to pay him, divided by what we got, what he paid for that, with the amount we paid to a broker taken off, and then we add the growth to it. Mallory.
If there's dividend included in the question, then we would definitely use DCF.
It'll actually say, calculate the cost of equity using DCF.
Oh, okay, great.
If it says that, then use that. Otherwise, you'll probably use the capital asset pricing model.
So if it doesn't state anything, use capital asset.
Yeah, there's nothing ambiguous like that.
Okay.
It'll either give you obvious capital asset pricing information.
So it's going to give you one of the two. You're not going to kind of throw us a curveball.
I will not. Okay.
Because we'll get you.
Yeah.
We'll find you.
Good. Okay. Boom, boom, boom. Okay, there was this one thing in terms of estimating the growth rate. And we talked about a retained earnings retention model. Say, for example, I'm getting a return on equity of 12%. Question is my company going to grow at 12%? Well, if I'm not paying out anything to my investors, if I'm not paying any dividends, then maybe it will. That's the appropriate rate. It'll grow at 12%. But if I'm paying out, say, 3/4 of that in dividends, and I'm retaining the rest of that, then I might expect my company to go at 3/4 of 12%, which would be 9%. So if for some reason you get a question that says, what would be the growth rate of this company that had a retained earnings of 12% and pays out 3/4 of that in dividends, or 1/3 or 1/4 of that in dividends, or whatever the way we said that. You can use this growth rate, the retention rate times the return on equity, or 1 minus the payout rate times the return on equity. Make sense? Oh. Weights, you'll just look at the numbers, determine the weights for WACC, and calculate WACC. Slide number 40 on class number 2. You can pretty much do it in your head. You can have that circled and bookmarked so you don't get stressed on the exam. Good. All right. Class 2, any questions on that? And if I'm going too fast, just tell me to slow down.
How many classes have we had altogether?
8 classes. This is the 9th class? Yeah.
Stanley.
Class.
Fast, the time's going too fast. I'm so happy.
5. Got capital structure decision. Okay. Oh, so this is capital structure. How much debt, how much equity. And we talked a lot about how we can use debt to increase the value of our company. That can be risky, but if we do it right,
That's when we did that slope and kind of where
Yep.
on
the
there.
perfect point,
Correct.
reserve borrowing capacity. All right. We talked about business risk versus financial risk. Business risk is just the risk you think about running a business. Will your customers buy? Will your employees work? Yada, yada. Financial risk, we use that example where suppose you invest $1 of your own money and then borrow $9 from the bank. that increases the volatility of your returns, and a very small decrease in profit can wipe you out completely. That is financial risk. And if you get yourself in that situation, your investors will demand more of a return because you're more of a risky company. Okay, capital structure theory. Modigliani and Miller gave us the zero taxes and corporate taxes, which we'll talk about briefly, which leads to the trade-off theory that Bill just mentioned with that perfect arc where the value is. Signaling theory, what does it tell the market when you ask for more equity or you ask for more debt? Which leads us to the pecking order theory. We'll talk for a minute about agency costs, reserve borrowing capacity, and then we'll talk about market timing just as an afterthought. In terms of Modigliani and Miller, their theory, they said with zero taxes, the value of the levered firm is the same as the value of the unlevered firm. But they didn't think about a couple things. Well, they thought about them, but they just didn't include them in this pure theory. They didn't include taxes, and they didn't include financial distress costs, such as bankruptcy. So they created another theory that did think about taxes. And they said with taxes, the value of the levered firm, which means with debt, is equal to the value of the unlevered firm plus the tax benefit. So when you're paying interest, that's tax deductible, that saves you money, that lowers the cost of your capital, and when the discount rate, the cost of capital goes down, value goes up. So as you put more and more debt in your company, the value of the levered firm gets greater and greater. But we need to think about the cost of financial distress. That brings us to the trade-off theory, which says as we increase debt by more and more, the chances of financial distress get greater and greater. All right, so what happens? So we've got the value of the firm on this axis, the amount of debt here. All right, the value of the tax shield goes straight up, but the value of the levered firm starts going up and decreases a little bit. And the reason why is your investors say, hey, wait a minute, you're taking this whole cheap debt too far. A very small decrease in returns could wipe out your whole company, cause another recession. So we're going to charge more and more for that capital. We're going to charge you higher rates on your bank loans, and for equity investors, we're going to demand a higher return. So your cost of capital goes up, the cost of your firm starts to go down, and you want to find that sweet spot. In fact, you might want to be a little bit to the left of that sweet spot. Why?
Risk.
Risk. Just in case, you might want to maintain a reserve borrowing capacity, because if you're right on the edge, and all of a sudden you see a great opportunity, borrowing a bunch of money might decrease the value of your firm, freak the market out. And it might send the wrong signal. So what sort of signal does it send to the market? If you decide, you want to, how do I want to say this? So the signaling theory indicates what the market thinks about our intentions or our value if we decide to issue more equity or if we decide to take out loans. So if we decide as a firm to sell stock, what sort of signal does that send about our opinion of our stock price? Okay, all right. If we decide to sell equity, ask equity investors for more money, sell them stock, what signal does that send about our opinion of our current stock price?
It's too low.
Isn't it if you're raising the stock price? Is that what you're saying?
No, the stock price is the stock price. So the stock price is currently $105 per share.
Okay.
We say, hey, you know what? We've got this new project. We want to sell another 1 million shares.
Okay.
Will you buy them? Come buy them. All right, what are you going to say?
What is going on?
They're increasing their projects. Is that what you were saying?
Yes, they need $1 million. So the question is, where do they get that money? Do they take out a loan for $1 million? Or do they sell stock for $1 million? Or do they use internally generated funds of $1 million?
So should they need income?
Yes, it'll bring us to the pecking order theory, which says we use income. Right, Mallory. Income might be our first choice, but why is it? What signal does this send to the market when we say we would like to sell stock?
You're looking to expand, I guess, or you're joining.
You're still
I get your point. I know what you
I remember this.
Yes.
Great. Explain, break that for us.
There's overvalue.
Okay, it might be overvalued. We definitely don't think it's undervalued. So when the stock price is high, we're going to say we want to issue more stock. If the stock price is low, we're going to want to take out loans. Or we're going to want to use internally generated funds. So when we issue more stock, investors are going to look at us and say, you're only issuing stock right now because you think your price is high. Alright, so that's the signal we need to be aware of. If we issue stock, investors might say, you're only issuing stock because you think the price is too high. That leads us to the pecking order theory, which suggests we should avoid issuing stock and sending the improper signals. We should first use internally generated funds, retained earnings. We should second